Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 1, we explored the basics of international bonds. Now, let's take a closer look at how to pick the best ones for your investment strategy. Currency risk. Exchange rates play a major role in international bond returns. If the bond's currency weakens against your home currency, your payout loses value when converted back. Here's how it works. A U.S. investor holds a Japanese government bond, paying 1% annually. Even if the bond performs well, a 5% drop in the yen against the dollar wipes out those gains. Emerging market bonds often offer high yields, but their currencies can be volatile. A 10% yield in Brazilian reais means little if the real plunges 15% in a year. How to manage it? Hedge currency exposure using ETFs or forward contracts. These lock in exchange rates up front. Diversify across multiple currencies so one drop doesn't tank your entire bond portfolio. Stick to bonds in stable currencies like USD, EUR, or CHF for lower risk. Political and economic risks. Geopolitical events and economic downturns can shake foreign bond markets overnight. For example, a sudden government default like Argentina in 2001 or Greece in 2012 leaves bondholders with heavy losses. Trade wars or sanctions, U.S.-China tensions, Russian asset freezes, disrupt bond payments or market access. High inflation erodes returns. Turkish lira bonds lost real value despite high nominal yields during recent inflation spikes. Strategies to reduce exposure. Favor bonds from politically stable countries with strong credit ratings, Germany, Canada, Australia. Limit allocations to risky markets. Even 5 to 10% in emerging market bonds adds diversity without overexposure. Monitor sovereign credit ratings from agencies like Moody's or S&P. Downgrades signal rising risk. Market turbulence isn't predictable, but balancing safer bonds with higher yield options helps cushion the blow. Credit risk is another factor. Companies or governments with shaky finances may miss payments or default entirely. Research the issuer's financial health before buying and consider bond funds for built-in diversification. Investing internationally means accepting some uncertainty, but with smart choices like mixing stable and growth-focused bonds, you can tap into global opportunities while keeping risks in check. How to invest in international bonds. Investing in international bonds doesn't have to be complicated. Whether you prefer a hands-off approach or want to handpick specific bonds, there are straightforward ways to get started. Here's how to add global bonds to your portfolio through mutual funds and ETFs. For most investors, mutual funds and ETFs are the easiest way to gain international bond exposure. These funds pull money from many investors to buy a diversified mix of bonds managed by professionals. Key advantages. Diversification in one purchase. Instead of researching individual bonds, you get instant exposure to hundreds or even thousands of bonds across countries and currencies. Lower minimums. Many funds let you start with as little as $100, while buying bonds directly often requires thousands. Liquidity. ETFs trade like stocks, so you can buy or sell anytime during market hours. Mutual funds let you redeem shares at the end of each trading day. Popular options include funds like the Vanguard Total International Bond ETF, BNDX, or iShares, JP Morgan EM Local Currency Bond ETF, LIMB. Some focus on specific regions or bond types like government debt or corporate issuers. What to watch for? Expense ratios. Keep them under 0.5% for broad market funds. Currency hedging. Some funds mitigate exchange rate risk, while others leave it exposed. Direct purchase of bonds. If you want more control, buying bonds directly is an option, but it's trickier than investing in funds. Here's how it works. Find a broker with global market access. Not all platforms offer foreign bonds. Major brokers like Interactive Brokers or Fidelity provide some international options, but inventory varies. Check the minimums. Single bond purchases often start at $10,000 or more, especially for sovereign debt. Corporate bonds may have even higher buy-ins. Research ratings and currency risks. Use tools like Moody's or S&P ratings to assess credit worthiness. Also, consider whether you're comfortable with potential currency swings. Pitfalls to avoid. Lower liquidity. Selling a bond before maturity can be hard, especially for obscure issuers. Hidden costs. Some brokers charge hefty fees for foreign bond trades. Always check the fine print. For most people, starting with a fund is simpler. But if you're experienced and want targeted exposure, direct purchases can work. Just tread carefully. Case studies of successful international bond investments. Seeing how international bonds perform in real life makes the theory click. Here are two standout examples, one from emerging markets, another from Eurobonds, where investors scored big by thinking globally. Emerging market bonds. In 2019, a basket of Indian government bonds surged ahead of most developed market debt. Yields hit 7.5%, while U.S. Treasuries struggled to break 2%. Investors who bought in early rode two waves. Strong economic growth. India's GDP expanded by 6 to 7% annually, boosting confidence in its debt. Falling inflation. Prices stabilized after food supply improvements, making fixed-rate bonds safer. The payoff. A $10,000 investment in these bonds returned over $12,500 in 3 years, including interest and rupee appreciation against the dollar. The Templeton Global Bond Fund capitalized on this trend, allocating heavily to India before the rally. Lesson learned. Emerging markets can pay off big, but timing matters. India's reforms made bonds attractive. Investors who waited for political stability before jumping in saw smoother gains. Eurobond success stories. Eurobonds let companies borrow cheaply in foreign currencies. In 2020, Microsoft issued 1.1 billion euros in euro-denominated bonds with a 0.625% coupon, far lower than U.S. corporate rates. Here's why it worked. Low Eurozone rates. The European Central Bank kept rates near zero, so Microsoft locked in ultra-cheap financing. Investor demand. European funds hungry for dollar giants bonds snapped them up, keeping prices high. The result? Microsoft saved millions in interest costs, while bondholders earned steady returns as the bonds traded above face value. PIMCO's income fund held similar euro bonds from Apple and Coca-Cola, benefiting from reliable payouts in a low-yield world. Takeaway. Eurobonds from top-tier firms can offer safety and yield in shaky markets. But watch currency spreads. Issuers often hedge their exposures, leaving investors to manage exchange rate risk. These cases show international bonds aren't just theory. With research, they can be powerful tools for growth and stability. International bonds offer a smart way to diversify your portfolio beyond local markets. They give you access to higher yields, reduce risk through global exposure, and can act as a hedge against currency shifts. But they also come with challenges. Currency fluctuations, political risks, and credit concerns require careful consideration. The key is balance. Mixing stable government bonds from developed nations with select high-growth opportunities from emerging markets can strengthen your overall returns. Whether you choose funds for ease or hand-pick bonds for precision, international fixed income belongs in a well-rounded strategy. Ready to explore global bonds? Start with a small allocation to test the waters. Over time, These investments can help smooth out market bumps and open doors to growth you'd miss at home. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.